Hello, everyone, and I'm really excited today. I have a very official, if you're watching the video of this, very formal looking library backdrop for my guest, Jesse. Mine is quite casual, my usual office, and today is a gorgeous day in Ottawa at the time of this recording. It's like 42 degrees, super hot, feels like I'm in the Caribbean. But welcome, Jesse, all the way from beautiful Calgary. I love your city. And today we're going to talk about a bit of a special topic. So, a mic, not a mic, not a microphone, but what is a mortgage investment corporation? And Jesse, maybe tell our listeners and viewers a little bit about yourself and Calvert Home Mortgage. Like, who are you guys if people don't know? Not sure where
Yeah.
they've been hiding, but some people may not know.
Well. Firstly, Francois, thanks for having me on, and to your audience, thanks for listening. Yeah, we're here in Calgary, and it's not nearly as warm. It's a very comfortable 26 degrees,
Lucky.
but the sun is shining, and yeah, it's a great time of year here. In terms of myself, Jesse Bobrowski with Calvert Home Mortgage Investment Corporation, I am a father of two amazing young kids, Ari, who's 6, Mila, who's 4,
Nice.
father of or husband of one amazing wife. And I have been in the real estate lending space essentially my whole career for coming on 16 years now.
Wow.
Yeah, after university, I moved out to Calgary in pursuit of a finance job, looking to be a trader. And very quickly into my career in 2007, I met a husband and wife couple who did their own syndicated mortgage lending. So, for your audience members who may not know, syndicated mortgage lending is when you put together a pool of lenders into a mortgage. And I did that for 8 years, and joined Calvert and 7 years ago, and we've successfully built the business from when I joined from a $35 million fund to today, which is a $310 million fund.
Wow, massive 10x. You've done the 10x, I guess, almost.
Yeah, we should hit that at the end of the year. And thanks to really an amazing business model, really great people from the ground up. I know you've met Francois with a lot of our staff and
In person in beautiful Calgary. That was so much fun. And you do have a great team. They're very friendly and knowledgeable, and they know what they're talking about. They live it themselves, which is great.
They live it. Yeah. And a big part of that success is on the model side, where we're focused on short-term residential lending, really focused on supporting real estate investors with short-term loans. And that very narrow scope has provided a lot of value to our clients and in turn to the business and our shareholders. So, that's a little bit about Calvert. If your listeners want to know more about Calvert and what we do, you and I have done a previous podcast where we got more into that and how we help with our short-term mortgage products to people that are flipping or are burring properties. We allow them to get in with as little as, in Alberta, $10,000 down. In Ontario, it's 20. We have a lot of innovative components to what we do. No appraisals, turnaround times, commitments, funding, sometimes same day. So,
Wow.
if your audience is interested on that, I'll plug both you and I, and they can go ahead and review that previous podcast that we did together.
Yeah, I'll put the link to the previous episode. Hey everyone, just wanted to pause and share with you a financing tip that helped us scale our portfolio and can help you too.
I'm Dahlia, founder of Streetwise Mortgages, and in today's episode, I would like to share with you some of the common misconceptions about financing. We're going to talk about value today. And let's start with value in residential financing. To determine the loan amount you qualify for in the residential world, when you're buying 1 to 4 units, the lenders look at your ability to carry the mortgage personally based on your personal income and income from your rental portfolio. They will also take into consideration the appraised value of the property, along with what you purchased it for if it's a purchase. Say you're purchasing a property for $500,000 and the appraised value comes in at $700,000. That's a fantastic deal. Traditional lenders will lend on the lower of the two numbers. Remember that. In this case, what you purchased the property for, which is the $500,000. A private lender, however, may be willing to lend on the $700,000. If the appraised value comes in lower than what you purchased the property for, say at $400,000 when you bought it for $500,000, then all lenders will lend on the $400,000, and any difference between the loan and what you purchased the property for, you will have to inject out of your own pocket. Let's now shift gears towards the value in the commercial space. And when I talk about commercial space, I'm referring to commercial properties, multifamily properties, mixed-use properties, and properties with 5 or more units. Many think that on a commercial property, the lenders lend at 75% of the value or 85% of the value with CMHC. Well, this is partially true, but let me explain. To determine the loan amount you qualify for on a commercial property, the lenders will look at the property's net operating income, not your personal income. And they'll take into consideration the appraised value of the property along with what you've purchased it for if we're talking about a purchase. The property's net operating income is the property's income and expense statement adjusted for some reserves that the lenders take into consideration, such as vacancy allowances, repairs and maintenance, admin, and so on. We have developed a sheet called the debt coverage sheet that auto-calculates the reserves that the lenders will take into consideration, so you don't have to figure this out yourself. To download a copy, you can go to streetwisemortgages.com/toolkit. Based on the NOI, or the net operating income, the lenders determine how much debt the property can carry. This is called the debt coverage. I've actually put together a 1-hour complimentary webinar to explain the concept of the debt coverage, how the lenders calculate it, and how that impacts the loan amount. You can request a copy of that webinar by emailing us at info@streetwisemortgages.com. Now, the loan amount determined by the debt coverage will play a huge role into the final approval. So let's take a look at an example. You are purchasing a 12 units apartment building that is valued at $3 million based on the appraisal. And you're buying it for $3.1 million. The debt coverage for the property with a conventional lender, these are the lenders who are willing to go up to 75% of the value, is 1.5. And with CMHC, which can typically go up to 85% of the value, is 1.1. Now, remember, the appraised value is $3 million. If you run the math, a conventional lender should be able to lend at 75%, which is $2.25 million, and CMHC should be able to lend at 85% of the value, which is $2.5 million. But because both of these loan amounts are higher than the loans determined by the debt coverage, the lenders will go by the lower of the two. Remember, guys, lenders are conservative, so they will go by the lower of the two. So on commercial properties, you have to remember that it's not the value alone that determines the loan amount. The lenders will always look at the debt coverage and the value and will go by the lower of the two loan amounts. In the next episode, I will cover other financing misconceptions. Until then, if you are looking for guidance with your residential or commercial portfolio, have a challenging situation, or would like a second opinion, reach out to my team at info@streetwisemortgages.com and we would be happy to assist. Cheers to your success.
Going back kind of to the basics. So what is Calvert Home Mortgage? It's a mortgage investment corporation. And I love that word, the little I, the investment part, because as an investor myself, I'm always looking for ways to diversify. And it sounds like there's opportunities to invest with Calvert. Like, yes, you could borrow, but you could be on the other side. Could you tell us more about that? Like, what's behind all this? Because
yeah, that's correct. So we are an investment vehicle. We are a fund that is made up of basically half of our money is the bank money that we borrow at really nice rates. Other half of the money is private equity, made up of predominantly high net worth individuals who have experience of investing in real estate. And I liked in the intro, where you list all the different topics you discuss. And to me, investing in a MIC is a much more passive form of real estate investing.
Yeah.
You're essentially giving your capital to the fund manager, to the MIC. You're buying shares and you're hoping for a return based on their lending practices. So in the most basic sense, a MIC is a mortgage investment corporation, which is a vehicle that is made up through the Canada Revenue Agency. We are a flow through. So our mandate is to lend on Canadian real estate, and at least 50% of it has to be on residential.
Okay.
And the way that CRA taxes us is they don't tax the MIC as a corporation, but the MIC every year has to return all of its income to the shareholders.
Oh,
so
the dividends.
In the form of interest income.
Oh, okay.
So don't get it confused with dividends. So
yeah, that would be cheap.
We would have more money than we can deal with.
A lot more.
So we don't get taxed. We provide that interest income to our shareholders in the form of interest income. So they get a T5, and then they're taxed against their highest nominal tax rate. So a lot of our shareholders will buy our shares through registered funds, through RRSPs or TFSAs, just because it's such a more efficient way to invest tax-wise. A lot of our investors also will invest through their holdcos.
And that was my next question. Can you use a corporation? Because maybe I'm not an accredited investor, but my corporation is maybe a high net worth individual.
As long as we can trace it to an accredited investor, which there's a laundry list of rules, but the most simplest way to look at it, the person behind the corporation or the individual themselves has to either earn 200 grand a year or have net financial assets in excess of $1 million. So
and is that across Canada or certain provinces? Because I know the amounts do vary from what I thought I heard, but
well, they'll vary if you use an offering memorandum. We don't. Okay. We only accept accrediteds, and that rule is straightforward throughout Canada.
National. Perfect.
Yeah. Now we're only registered in Alberta, BC, Saskatchewan, and Ontario at the moment. So we only accept money from people in those provinces. Luckily, that in terms of a population base, that's the bulk of Canada anyhow. Yeah. So yeah, we're a fund who we accept money through the purchase of shares. We do our best to firstly preserve capital. That's our number one priority.
Warren Buffett, don't lose my money.
Don't lose my money. And over 40 years of operating this MIC, we've done a really good job at it. We've never lost money. We've had 2 years at the very early stages of the inception of the fund when the Alberta economy was going through a lot of trouble, where we didn't return a return. But our goal within our fund is to return 8 to 10% annualized to our shareholders based off of our current lending strategy and risk parameters and portfolio strategy. And we've accomplished that. We're at an over 10% return over the last 10-year period. So yeah. And I want to talk more holistically about MICs in general.
That's it. Because I know there's many. I'm in Ottawa. I think we have like 8 or 9 locally. There's lots, but I'm sure they're not all the same as well. Like there's particularities and things. So things to look out for as well, I'm sure.
Yeah, they're not all the same, and I like to speak in generalities because we're far from the only option, and so all the mix though will be structured the same in terms of
By law, I think.
how they return their income, but they all have different mandates. Everybody uses a different lending strategy. Everybody uses a different portfolio strategy. So a lot of mix, we're unique that we focus on short-term stuff. The bulk of our peers will focus on more longer-term lending.
Yeah.
So they'll be lending to people that are just outside the B lending space, so just outside a home trust or an equitable bank, and they'll have lower rates than we do, although much longer terms, and their return will look different. Things to look out for. I think one of the key things is the management team, because you are providing your capital to a fund, so there is a high level of trust there that the management team has the strategy and is going to execute the strategy. So when looking at the management team, the biggest thing that I like to promote is track record. How long have they been in the market? How long have they been doing this?
Yeah, because there's some very new mix. I've seen some names like 3 years old, 5 years old. That's a interesting track record.
Yeah. And we all have to get started somewhere, but maybe the mix were founded by, like, for those newer mix, when I'm looking to place my capital,
who's involved?
I would look, have the fund managers been through a downturn?
Yeah. And right? Some may have been through 3 of them, then okay, that's a different story.
Yeah. What did you do to it through the downturn? How did your portfolio perform through the downturn? What strategy or what did you learn from previous downturns that you're using in your current model?
Yeah.
So if you got the 3-year-old Mick where they've never been through a downturn, and that you might want to think about a lot better. They don't have a strategy how to manage downturn. You might want to think about that. Also, you're going to want to look at what their lending strategy is. So where are they lending their money? What type of products? Lending on a single family house has a lot different risk and underwriting criteria than lending on 160 acres of development land 10 kilometers outside of Ottawa.
Yeah.
You're going to want to look at loan to value. What is the loan amount versus the value of the underlying asset? Because at the end of the day, all these mix are secured lenders. We're lending on mortgages.
Yeah.
So the loan to value is a really good way to understand their risk. And to book a business that is at 60% loan to value on single family houses is a lot lower risk than 60% loan to value on development land 10 kilometers outside of Ottawa.
Yes, that's for sure.
So you're going to want to look at that. You're going to want to look at portfolio composition. So where are they lending their money geographically? And
you can get all that information by talking to someone or a website, or how do you get all those details?
You should be able to get all those details through ID. Talking to someone is great, but they need to be able to put it in writing.
In writing, yeah.
So the fund manager should have all this information at their fingertips.
Okay.
For instance, for us, we report all of this plus a lot more in our quarterly financial report to shareholders. Those are audited annually. We also have a board of directors that reviews them. We have an audit committee that approves them. So there's a lot of very sophisticated third parties that are confirming our numbers.
Yeah.
You're going to want similar assurances with other mix. Also, a lot of where our information comes from is we have systems, accounting, administration, portfolio management, that it's there for me. So we use a dashboard called Power BI, Power Business Intelligence. It's a Microsoft product, and I can tell you in real time what my average loan to value is. I can tell you how much money I have in Ottawa, how much I have in Waterloo, and it's refreshing it every 10 minutes.
Wow, very precise then.
Very precise. And what's great is when I have the investor conversation and I'm doing the pitch, I can literally pull that up. So a family office looking to place $5 million with us are going to have different questions than a doctor who's placing 150,000 with us.
Yeah.
But we manage such a large amount of capital that we have everywhere in between. So we're very familiar with those questions, but more importantly, we built our business on transparency. Transparency to our shareholder, transparency to our borrowers, transparency to our board, auditors. So we really pride ourselves on having it there. So as should the other fund managers. So when you're looking into options, ask the hard questions. You're looking to place this money that you've scratched and clawed for, your blood, sweat, and tears, your investment capital that has not come easy. So treat it with the utmost respect when you do your due diligence for where to place it, and any question should not be a burden to a MIC manager.
Very cool. Great description of a MIC and what to look out for. Is there anything new at Calvert for this kind of second half of 2022?
Well, yeah, we're going through a really interesting time in
yes, you can say that
in world and Canadian economics.
Yeah,
like this inflationary period is rare and in some instances unprecedented. So as we're seeing the policymakers try to curb inflation through predominantly increasing interest rates, that will have an effect on buying power, on buying habits, which will in turn impact the housing market. So what Calvert is doing is we're really focused on taking the lowest risk possible. So what we've done at Calvert is we've increased our interest rates on the higher risk stuff. So the higher loan to values, the less down payments, but low. Like luckily we've been because of our borrowers and employees, we've been really successful, and we don't have to pass on all of our costs to our borrowers. So where banks have increased their pricing lockstep with the Bank of Canada, 2.25%.
Yeah, it went right up.
We've only increased pricing on a fraction of our book by 1%.
Okay, so reasonable.
And really strategically, it's just the higher risk stuff that we've increased to encourage our borrowers to borrow at lower risk parameters, put more money down, take some risk off the table for us and you. So that's something new that we're dealing with right now that we're actually just rolled out internally, and your listeners are hearing it for the first time because we haven't rolled it out en masse to the market, though that will be going out next week. But we still see a lot of really great opportunity for our borrowers. Yeah. Like a lot of the more sophisticated real estate investors have been waiting for this opportunity for years.
Mm-hmm.
Seller psychology has shifted. Our flippers and our BRRRR clients, they make money when they buy. And in today's market,
it's a good time to buy.
You can buy pretty aggressively.
Anywhere in Canada.
Exactly. And provided you buy aggressively, there's a lot of profit in it for you. So you reference Warren Buffett, when there's, I love one of his quotes, when the market is greedy, be fearful. And when the market is fearful, be greedy.
Yes.
So you may want to heed some of that advice for our borrowing clients. For investors, nothing really new. We're looking at our year end, by the way, is February 28th to coincide with our RSP season.
Oh, it makes sense.
So we finished our first quarter end of May and released our results, and we have a really good. We're on a really good pace this year. So we're still seeing opportunity to lend our money out safely. And as part of that opportunity, we're going to raise another $26 million throughout the next 7 months. So we're going to do that through a combination of, we have the equity that we talked about. We also have a corporate debenture product. So the debenture sits between, like, if you look at, I like to call it a capital stack. So we have first of the $305 million that we're managing right now. I'm going to use round numbers.
Sure. Yeah. We don't need the sense.
About 150 million is from the bank. About 140 million is from equity, and 15 million is from debenture holders. So
Okay.
it's secured behind the bank in front of the equity, so a bit more secure, and we offer a fixed rate return. So we're going to attract money through both of those instruments.
Great. Yeah. So again, opportunities to invest passively. And earlier on, we were talking about that being active and then passive. I know a lot of investors that have been quite active. Now they're accredited investors. They've got money coming in. And maybe they're concerned, like some people want to maybe hit pause, take a break because materials, labor is so unpredictable. Maybe they want to invest more passively or diversify, have some passive investments and some active investments. So this is a great opportunity to work with you guys and to grow.
Yeah, it's always, I love what you said there about the passive, but I really like what you said about the diversification. Like you always want to diversify your portfolio, and if you're interested, maybe we can be one piece of that diversification strategy. We are definitely, we're considered an exempt market product, so it would be an alternative product. So it should be part of your alternative strategy. Yeah, like a lot of our investor makeup is, again, high net worth individuals who come from a background in real estate investing. Although not all of them are that. We have a lot of lawyers who invest with us. We have a lot of we call them family offices. So these would be generational wealth, where they're now actively managing that wealth they built over years. So this would be families with $20+ million that like us and invest in us. And we also have some IROC dealers, so some money managers that choose to invest with us as well.
Great. Very cool. And is there any expansion at Calvert? Is your team growing, or are you, because I know you expanded to Ontario. How long ago was that? Maybe 3 years now?
2 years now.
2 years. Okay.
So our team is always growing. We're always looking for really great people and talent to help complement our business. We're in the process of hiring a treasury manager as our business grows. Our capital requirements change, and the modeling is really like, you can do banker's acceptance, you can hedge, even how we raise money can have like quarter, half, $1 million swings for the business. So wow. It's important that we really have our eye on the ball in that regard. So we're hiring there, and that's really the neatest position we're hiring for right now. But we still think we have a lot of room to grow in Ontario. For instance, this year we'll do about $500 million of lending, and call it 200 million will be Alberta, 300 will be Ontario. By sheer size and amount of transactions, Ontario, when we have Ontario covered, it should be 4 times the size of
that's it, just population and all
Alberta.
That.
Yeah. So although we've been in Alberta for 40 years, so it might take a little while to fully capture the Ontario market. But we're also looking at and writing a business plan for expansion to BC.
Great.
We'll enter BC like we do anytime we look at an opportunity, with a lot of research, with a really strong plan, and in stages. So we plan to enter BC. It'll be our same focus, lending to real estate investors who flip or burr. We also do bridge loans, and we really love that short-term stuff. So we'll enter with that mandate. And we think, this time next year, I think would be reasonable for us to be actively lending there.
Very cool. And I don't know if you've read, in Ontario, there's talks about creating what they call, I'm not sure, I was reading it in French, but like strong mayors or something for Ottawa and Toronto, where the city mayors would have more power over land development, because the government has promised building at least 1.5 million new apartments or houses or some sort of housing in the next 10 years. So they're really changing their rules. So I agree with you. There's going to be lots happening here in Ontario. and in BC as well, they're seeing all kinds of changes population-wise, and well, Alberta as well is seeing a lot of Ontarians leaving to Alberta. So we're seeing new Ontarians in Ontario. So I'm not sure
we're
if
seeing
you know
a very
anything about that.
yeah, I do. I know. I read a headline this morning on that end. I haven't had time to really read the full article and digest it, but one of our real theses at Calvert is that Canada is extremely underserved as it relates to single family housing.
Yeah, it still is.
there's just not enough supply, and a lot of that has to do with policymakers.
Yeah,
and we're trying to curb urban sprawl, and that's created this big difference between supply and demand, which has increased prices. Well, if we created some supply, we should be able to create more affordable housing. So that's one part of our thesis. Another one is we're going to bring in a lot of immigration, and they, for the most part, are economic immigrants who want real estate. So that's going to compound the demand. And one solution for sure is making it easier to develop raw land.
Yeah.
But another solution that we believe is what our flippers are doing is they're buying houses that the market doesn't want because they're so dilapidated, they're run down, and they're creating housing stock. So one of our big bets is that will continue, and that's the business that we're focused on.
Yeah, because there's tons of kind of inner city neighborhoods, and in Ontario now, more and more kind of older suburbs from the 50s, 60s, 70s that are kind of run down, not as desirable. But now you get some flippers fixing a few places, and this neighborhood is now more appealing. It's closer to transit and all the fundamentals. Maybe they're adding basement suites because the basements were never even finished anyway. Like a lot of houses, especially in Ottawa, the houses are some of them are so big, you never use that basement. So if a flipper adds in a basement suite, now you've created a new unit and you still have kind of a nice single family house, but it's no longer a single family house. It's kind of a gentle densification. And the city of Toronto is working on that as well, because most of Toronto is still low rise. A lot of people see all the high rises, but that's more central. Yes, like some suburbs, but most of Toronto is still very low. Nothing compared to Calgary, though. I was shocked with how everything is single family homes, but still there's opportunities there, and we're going to see lots of growth. So I'm glad to hear Calvert's kind of mission unofficially is to help with that kind of the growth and the increased demand in housing. So if our listeners want to get a hold of the team at Calvert, either to borrow or to lend, what's the best way to reach your team?
So Google us, and our email or our website will come up. It's chmic.ca. That it's a great resource. It has a ton of information on borrowing, on our different products, tips for flips, market updates. We try to our goal is to educate people to make sound financial decisions. So our website, we have a similar mandate we have the same mandate, I should say, with our Instagram. Follow us at Calvert Home Mortgage. And you can get a hold of anybody on our team. You'll see our contact information on our website. My email is simply jesse@chmic.ca, but certainly website, Instagram, easiest to follow and get a hold of us.
Excellent. Wow. Well, thank you so much for sharing a bit about the background, the story behind Calvert and MIX in general, and what investors should look out for. And I can't wait to catch up with you in a little while, see how this crazy economy is going and what's next, like your returns and all that. I can't wait to hear again, and we'll have to catch up next time I'm in Calgary. So thanks a lot.
We missed each other last time, and for sure I look forward to catching up in person next time, and love your platform, love your audience. So would be happy to be a guest anytime you're looking for someone, and hopefully we're providing enough value where you'll look for me to grace your presence again in the near future.
Absolutely. Thank you very much.
Thank you, sir.
Hey there, listeners. We hope you enjoyed this latest episode of the Wine and Real Estate Podcast.
Yes, absolutely. You can find us on Instagram. Our handle is wine_and_real estate. So wine and real estate. On Facebook, FL Homes Corp. And you can also find us on our YouTube channel.
Yes, and please make sure to give us a rating, 5 stars, or any comments. We'd love to hear from you. And we love suggestions as well. Cheers.
Yeah, chin chin.